Early in the year, concerns about the global banking system were raised by the U.S. banking crisis. In quick succession, three mid-sized U.S. banks, Silicon Valley Bank, Silvergate, and Signature, fell, bringing down the price of bank shares all around the world. Is there another banking collapse shortly? Well, let's analyze the situation. The Federal Reserve, the central bank of the United States, provided the bankrupt banks with substantial sums of money and set up a lending facility for other struggling institutions. As a result, investors were at ease and there was no quick spread of the problem. Instead, only one other U.S. regional bank, First Republic, failed a few weeks later. However, it's not entirely apparent if the crisis has ended or not. What is likely to happen as traders return from their summer vacations and enter a time when market volatility is common? In recent months, central banks have kept raising interest rates to combat persistent inflation. The Fed increased its benchmark interest rate to a maximum of 5.5% in July, the highest level in 20 years. Even though the hikes have slowed this year, a rapid change in rates can be extremely devastating for banks, especially given the U-shaped swing in rates that has been occurring since the global financial crisis of 2007 to 2009. The rating agencies have exerted additional pressure. Fitch reduced the rating of U.S. government debt from AAA to AA+ at the beginning of August. It noted the likelihood that public finances will deteriorate over the following 3 years and the never-ending political wrangling over the debt ceiling, which is the maximum amount the government is permitted to borrow. The downgrading of a sovereign frequently reflects issues with the larger economy. By making banks appear less creditworthy, can destabilize them and lower their credit rating. Because of this, it might be more difficult for them to borrow money from the markets or even the Fed. The capability of banks to lend money, capital reserves for handling bad loans, overall profitability, and share prices may all be negatively impacted as a result. Unsurprisingly, Moody's lowered the credit ratings of 11 U.S. mid-sized banks a week following the Fitch decision, citing rising financial risks and pressures that could hurt their profitability. Additionally, it stated that State Street and Bank of New York Mellon were at risk of a future downgrade. S&P Global Ratings, the other major rating agency, has subsequently done the same, and Fitch is threatening to follow suit. According to our study, bank downgrades tend to make them riskier and more unstable, especially when a sovereign downgrade is also involved. Some have questioned whether the country is about to see a new widespread banking crisis in the wake of the March collapses of Silicon Valley Bank and Signature Bank, two of the largest U.S. banks to fail since the Great Depression of the 1930s. With more than $209 billion in assets at the end of 2022, SVB was the second largest bank to collapse since the Federal Deposit Insurance Corporation began keeping records in 1934. SVB catered to technology startups and venture capital businesses. At the end of 2022, Signature had nearly $110.4 billion in assets, making it the fourth largest bank failure when adjusted for inflation. Signature served numerous large New York law firms and real estate companies as clients and was one of the few mainstream banks to seek out cryptocurrency deposits. The United States had seen two significant banking crises since the FDIC was established during the Great Depression, both of which failed hundreds of institutions. The extended savings and loan crisis decimated that industry 4 decades ago. According to a Pew Research Center review of FDIC statistics, more than 2,900 banks and thrifts with total assets of more than $2.2 trillion collapsed between 1980 and 1995. More recently, the global financial crisis that followed the housing meltdown led to the failure of more than 500 banks between 2007 and 2014, with total assets of approximately $959 billion. Included in this is Washington Mutual, the biggest bank failure in American history. When WAMU failed, it had assets worth about $307 billion, or more than $424 billion in today's currency. The totals exclude investment banks like Bear Stearns or Lehman Brothers, which were not federally insured, as well as banks like Countrywide Financial and Wachovia that were pressure sold but didn't fail. American financial failures have typically been rare, at least since the conclusion of the Great Depression, save from those two crisis periods. 5.3 banks failed year on average between 1941 and 1979. Between 1996 and 2006, there were 4.3 bank failures on average each year, and 3.6 between 2015 and 2022. It had been more than 2 years since the last bank bankruptcy before SVB and Signature. The scene was drastically different from a century ago. In each year between 1921 and 1929, 635 banks collapsed on average, according to FDIC statistics. Since many states only allowed banks to have one office, the majority of these were small, rural banks. Only 8 states had deposit guarantee funds, so those who had money in a bankrupt bank were essentially out of luck in their absence. Therefore, depositors had a compelling incentive to withdraw their funds as soon as the crisis appeared. The Depression severely damaged the nation's financial sector. More than 9,000 banks failed nationwide between 1930 and 1933. Many of them were sizable, reputable, urban organizations. The limited state deposit guarantee funds quickly became insufficient. In total, or 19.6% of all deposits, depositors in bankrupt institutions lost more than $1.3 billion, which is $27.4 billion in today's currencies. After being established in 1933, the FDIC spent the following 10 years clearing up the ruins of the American banking system. However, because Federal Deposit Insurance closed an average of 50.7 banks per year between 1934 and 1940, depositors urged to flee problematic banks before they failed was significantly diminished. Bank failures can occur for a variety of reasons, but they typically fall into one of 3 broad categories: a run on deposits, which leaves the bank without enough money to pay everyone who wants to withdraw their money, an abundance of subpar loans or assets that decline sharply in value, both of which deplete the bank's capital reserves, or a discrepancy between the bank's earnings on its assets, which are primarily loans, and the cost of its liabilities, which are primarily deposits. Quite often, more than one of these influences is at play. For instance, as the Federal Reserve swiftly increased interest rates, SVB's sizable holdings of government bonds saw a decline in value. At the same time, more SVB clients started taking their money out as startup funding became more difficult to come by. Anxious depositors accelerated their withdrawals when SVB took extreme measures to strengthen its balance sheet, including selling off its entire bond portfolio at a $1.8 billion loss and announcing it would sell $2.25 billion worth of new shares. According to the bank's call report for December, approximately 86% of SVB's total deposits were above the $250,000 insurance maximum at the time. According to a recent Pew Research Center survey, about a third of Americans say they are very concerned about the stability of banks and financial institutions, which is significantly less than the shares expressing that level of concern about consumer prices and housing costs. This has banking industry observers wondering if more dominoes will fall. Additionally, banks shouldn't count on much support from the general people. An October 2022 Center survey found that 40% of Americans believe banks and other financial institutions have a favorable impact on how things are going in the nation now, while 56% believe the opposite. Despite all of this, there are advantages for U.S. banks. At least, it is anticipated that interest rates and bank deposits will stabilize in the upcoming months, which should benefit the industry. The decline in deposits and net interest margins in European banks over the past few years helps to explain why Credit Suisse sought support from fellow Swiss bank UBS in March. However, during the past 2 quarters, European deposits and profit margins have been on the rise. However, recent stress tests conducted by the European Banking Authority found that major EU banks are solid. Banks in the UK seem to be doing a little bit worse than banks in the EU. Although their balance sheets still show resilience, the recovery of their deposits has lagged behind that of Europe. Additionally, they have been lowering their profit projections in preparation for future rate increases by the Bank of England. The regulators intend to significantly raise the minimum capital requirements that large U.S. banks must maintain to bolster the U.S. industry. Although the complete implementation of these initiatives to strengthen banks' ability to absorb losses would take more than 4 years, they are optimistic nonetheless. International banking regulations, known as Basel II, were created in 2004 with a similar goal in mind, but they were not put into effect in time to stop the global financial crisis. For the time being, both financial system shocks and more widespread disasters can still affect the US banking sector. We won't be able to confidently declare that the worst is over for a few more months. That's it, guys. When will the banking crisis be over, according to you? Let us know in the comments. For more content like this, subscribe to our channel. Thanks for watching.